So those within the organization, such as employees and managers, or even pensioners. Connected, we have customers, suppliers, and shareholders. So those who are very close to the organization. Then external stakeholders, we have government, tax authorities, the community, and the lenders. Those are some of the stakeholders. So it's important to understand these stakeholders. Now, these stakeholders can be in conflict. For example, shareholders want dividends, while employees want higher wages. This is a conflict because if you pay higher wages, there will be no profit or less profit. Less profit will lead to less dividends or no dividends at all. Government needs more tax revenue while business wants to reduce tax. So businesses try as far as possible to reduce tax, but governments need more taxes. Now, remember, people who are managing the organization are agents. So they work on behalf of the owners, the shareholders, who are the principal. So what is an agency theory? So agency theory looks at the relationship between the owners, the principals, and the managers, who are agents. So there's one problem in agency theory. The main problem is that managers may not always act in the owner's interest. Owners want to maximize dividends, but the managers want to maximize their salaries. Now, the main agency problem that we have is known as divorce of ownership and control. For example, shareholders own while managers control. So you can own a company, but the one who's controlling it is another person. And also, conflict of interest arises. The other person wants profit, the other person wants bonuses. How do we avoid this agency problem? So the best way to reduce the agency problem is to go for managerial reward schemes, e.g. share options or bonuses. So people should be rewarded based on options or bonuses. And also should have a strong corporate governance and monitoring. So to make sure that we monitor these managers. So to avoid the agency problem, we should motivate our managers in such a way that we reward them with schemes. So let's look at managerial reward schemes. So managerial reward schemes can include bonus based on performance. So if you achieve this amount of profit, we'll give you a bonus based on the profit. And also profit sharing. We can say if the company makes a profit of 200 million, we'll share you 20% as a manager. Then also have share option plans, share ownership plans, where as a manager you might have the privilege of owning the company in future. What's the benefit of rewarding your managers with share schemes? So the first benefit is that it aligns managerial interest with shareholders. It aligns managers' interest with shareholders because shareholders want profit. So if as a manager you are working towards profit, it means you have the same interest. It shall encourage managers to perform better. So managers will always be motivated to perform. And also, it will lead to attraction and keeping the employees viable to an organization. So those employees which are variable will still be retained within the organization. It shall create an organization focused on continuous improvement. So organizations always want to improve because people want to have ownership as well. Challenges of reward schemes. So if you reward people with shares, so what will be the challenges? One, it may encourage short-termism. So people might just be interested to get the shares or the bonuses in the short term. And there's a risk of manipulation of financial results. So managers might see that the only way to achieve profit is to reduce expenses. For instance, self-interest performance may be encouraged at the expense of teamwork. So managers will be more interested in achieving their own interest, bonuses, rather than the performance of the whole organization. And they undervalue intrinsic rewards. So intrinsic rewards like motivation, means of accomplishment, those might not be valued because people just focus on money. Yes, Ruth. That's
Okay. I wanted to ask much on first point that it encourages short-termism.
Yes.
Like we are rewarding someone the shares.
Mm.
So
And not only shares, but sometimes you can reward that person bonuses.
mm, yeah, okay.
So those bonuses can encourage short-termism because the person will just be interested in
Mm.
achieving a bonus in the short term.
Okay. I was thinking it in an angle of shares
Yeah,
because
okay, yeah, in shares
I
it's a
was,
long term.
mm. Okay.
Okay. Okay. One of the tools or one of the ways to reduce urgency problem we say is reward schemes. The other one is corporate governance. So what is corporate governance? Corporate governance is a system and process to direct and control companies. So how should we direct the companies and how should we control them? So corporate governance will ensure that we are accountable for our tasks, ensure there's fairness, and to ensure there's transparency in the business. So there are various corporate governance codes that we have, which we have learned maybe in risk management, such as the cut by report, green by report, harmful report, so many codes that we have. But in summary, those codes provide some of the principles of corporate governance. For instance, separation of the chairman and CEO roles. So the chairman should be a different person, the CEO should also be different. There should be independent and executive directors. An organization should have both executives and non-executives. Non-executives are those who come from other companies. There should be an audit, remuneration, and nomination committee. So should have an audit committee in place, responsible for the audit, remuneration committee responsible for salaries, and nomination committee responsible for appointments of directors. Now, the board should be responsible for taking major policy and strategic decisions. Not everyone should make a decision by the board. And when we are trying to remunerate people, we should ensure that the remuneration should be based upon organizations and individual performance. And also the board should maintain regular dialogue with institutional shareholders. So now and again, the board should make sure that it tries to interact with institutional shareholders. Institutional shareholders are companies which buy shares in other companies like Nico, maybe other pension companies, they buy shares in other companies. So what's the role of directors? In summary, executive directors, they are there to run the day-to-day business operations. So the one who is in charge of executive director is the CEO. Non-executive directors, they are there for oversight, so overseeing how the executive directors are performing, and are there to provide independent judgment. Next, we should appreciate measuring corporate objectives. So how do we measure company objectives? So when measuring company objectives, we use ratios. So the common ratios that we use include profitability, liquidity, efficiency, gearing, and investment ratios. So So what will happen when we calculate these ratios? We are going to note significant trends and we are going to make comments. Maybe a ratio has increased by 6%. Why? It has decreased by 4%. Why? That's what we'll be doing. So we'll start by appreciating profitability and liquidity ratios. So the main profitability ratios are gross profit margin, net profit margin, return on capital employed, asset turnover, and return on equity. So let's start with gross profit. So gross profit margin is calculated as gross profit over sales times 100. So what does this ratio mean? So this profit actually measures profit made on a $1 sale after covering production costs. In simple terms, when we take sales minus the cost to make that sale, are we profitable? That's what this ratio looks at. Are we able to cover our production cost or our cost of sales? Net profit margin, on the other hand, it looks at operating profit over sales times 100. So you basically look at your ability of the company to cover your gross profit. In simple terms, is our gross profit able to cover operating expenses? Because after gross profit, the next section is operating expenses. So are we able to cover operating expenses? Then return on capital employed. So out of the capital that was invested, are we having a return? So the formula is operating profit over capital employed times 100. Capital employed, basically, we look at total assets minus current liabilities. That's the capital employed. Or you can say total equity plus non-current liabilities. So this ratio measures how efficient our business uses capital to generate profit. Asset turnover. Asset turnover is calculated as sales over capital employed. How many times does our capital employed go into sales? So basically, it means our efficiency in using assets to generate sales. If you have got a machine, maybe you have got a blade making machine, we bought it at 1 million. How much sales is it going to generate? That is the asset turnover. How many times does this machine generate sales? So if the sales is 3 million, it means we have generated sales 3 times more than the cost of the machine. Return on equity, calculated as profit after tax over equity times 100. So how much return are we getting per share? So it will be return generated on shareholders' funds. That's what we are looking at. On the shareholders' funds, how much return are we generating? So those are the 5 profitability ratios: gross profit, net profit, return on capital employed, asset turnover, and return on equity. So they might ask in the exam to say comment on the profitability. So it means you have to know those ratios. So most of these will be asked as a multiple choice question.